How do you calculate a mortgage rate cap? If you're considering an adjustable rate mortgage, you might be wondering how to calculate the mortgage rate cap. This is a crucial piece of information to understand, as it can significantly impact your monthly payments and overall financial stability. To start, let's break down what a mortgage rate cap is. Essentially, it's a limit on how much your interest rate can increase over time. This cap is particularly important for adjustable rate mortgages (ARMs), where the interest rate can change after an initial fixed period. Here's how you calculate and understand these caps. First, you need to know the different types of rate caps involved in an ARM. There are three main caps: the initial adjustment cap, the subsequent adjustment cap, and the lifetime adjustment cap. Initial adjustment cap. This is the maximum amount by which your interest rate can increase after the initial fixed period. For example, if your initial fixed rate is 4% and the initial adjustment cap is 2%, your new rate could be as high as 6% after the first adjustment. Subsequent adjustment cap. This cap limits how much your rate can change in subsequent adjustments. Typically, this cap is 2%, meaning if your rate was 5% before the next adjustment, it could rise to 7%. Lifetime adjustment cap. This is the maximum amount by which your interest rate can increase over the entire life of the loan. For instance, if the initial rate was 4% and the lifetime cap is 5%, the highest your rate could go is 9%. To illustrate this, let's consider an example of a 5-1 ARM, which means you have a fixed rate for the first 5 years, and then the rate adjusts every year thereafter. If you have a 2-5 rate cap, here's what it means. The initial adjustment cap of 2% means your rate can only increase by 2% after the first 5 years. The subsequent adjustment cap of 2% means each subsequent year, your rate can only increase by another 2%. The lifetime adjustment cap of 5% means your rate can never exceed 9% over the life of the loan. When shopping for an ARM, it's essential to run the numbers to see if you can afford the worst-case scenario payments. You should consider whether the potential rate increases fit within your budget and whether an ARM or a fixed-rate mortgage is better for your financial situation. In summary, calculating a mortgage rate cap involves understanding these three key caps and how they limit the potential increases in your interest rate. By knowing these caps, you can better manage your financial expectations and make an informed decision about your mortgage.